And joining me now is the co-editor of Morningstar Opportunistic Investor, Justin Perucki. And Justin, great to have you with us.
Good morning.
So the unusual deal, there's a couple of unusual parts about this deal or this IPO, but the first I want to tackle, which is that they're really just using this money to cash out their insurance owners. So you've got to wonder whether, what makes this so attractive if all they're doing is just replenishing capital.
Sure, it's obviously a risk when evaluating IPOs when the insiders are selling such a large stake. However, what made us interested in looking at this IPO was the fact that Warren Buffett, one of the shareholders, is not selling their stake, and so it's kind of a vote of confidence in the business.
Right, and Berkshire is not selling out, but others are, and so you've got to wonder, though, if these insurance co-owners or owners are selling out, isn't that going to affect the business? I mean, doesn't that create less incentive for these companies to continue their business with Verisk?
Well, something that's interesting is that these they're P&C insurers, AIG, Hartford Financial, companies that aren't doing very well right now. They got hit in their investment books due to the disruption in the financial markets, and on top of that, they're also had a bad underwriting season the past year or so. And so I'm not, at all concerned about the future viability of the business. This is a very entrenched business, very stable operating margins, strong free cash flow, and I think that's kind of why Buffett's staying around.
Hey, Justin, it's Adam. Was reading one report that says, given the $22 pricing, this stock is likely to trade somewhere around 30 times net income. That's not exactly cheap. Any comments in terms of that theoretical valuation, if this is really where it opens?
22, we still think the stock maybe is close to fairly valued as of right now. However, I think that there's a good chance that it trades closer to in the high 20s over the next couple years. And so at 30 times income, yeah, that doesn't sound very cheap whatsoever. However, the company is growing and there's a lot of operating leverage in the business, so profits should grow faster than the top line.
And what's a fair estimate for growth in earnings as we look out to 2010, maybe 2011? Any thought?
Sure. Obviously, the company's targeting about 10 to 12% growth. I think some of that's going to come through acquisitions, and so some of that brings along additional cost. I think on top of that, they're going to be buying back shares. They generate a lot of free cash flow. So I think something in the low to mid-teens is very reasonable in terms of bottom line growth for them.
Speaking of that earnings growth, one of the portions of the business is called Decision Analytics, which focuses on mortgage fraud, which is obviously a big theme we've heard about with the crisis. What are the growth prospects in that business?
Sure. Obviously, they're very entrenched in the mortgage business and also the healthcare business. However, there's a lot of healthcare insurers out there right now that are not using their products, and so there's a lot of opportunity there. Obviously, there's some concern on our front that it might be lower margin business than what they're generating in the risk assessment business. However, I think the company still generates high 30% EBITDA margins in the business, so not too concerned there. However, growth is somewhat uncertain, as you point out.
Okay, well, we'll be watching that, of course. Thank you so much, Justin. Justin Perucki of Morningstar.